Gold just hit $5,400. Gold is surging. Gold is doing exactly what every financial expert on the planet said it would do during a war. And silver that has been in supply deficit for 6 consecutive years. Silver that has 30 times normal lease rates screaming physical scarcity. Silver that sits inside every solar panel and every electric vehicle and every AI data center being built on this planet right now. Silver is sitting at $95 going absolutely nowhere. And if you are holding silver right now, I know exactly what you are feeling. You are feeling confused. You are feeling frustrated. You are maybe even feeling scared. And I am here to tell you that feeling, that specific uncomfortable feeling, is the most important signal in the entire precious metals market right now. Because you are not seeing weakness. You are seeing the most powerful coiled spring setup in commodity market history. And by the end of this video, you are going to understand exactly why silver is behaving this way, exactly what is holding it back, and exactly what happens when the force that is holding it back disappears. Stay with me, because what I am about to show you changes everything. Before we go 1 second further, and I mean this, if you have never watched this channel before, I need 30 seconds of your attention right now. Because what we do here is different from every other financial channel on YouTube. We do not recycle headlines. We do not tell you what you want to hear. We do not water down the complexity of what is actually moving these markets. Every single video on this channel is built on one promise: real data, honest analysis, zero agenda. We launched 3 videos ago into the most volatile commodity market environment in modern history. And every video since has delivered the kind of analysis that most channels on YouTube simply do not have the courage or the capability to produce. Today, that standard gets pushed further than it ever has, because today's silver story is the most important and the most misunderstood story in the entire financial market right now. So hit that subscribe button, hit the bell, and do not move. Because the next 20 minutes might be the most valuable 20 minutes you spend on YouTube this entire week. Here is the value proposition of this video in 3 sentences. By the time this ends, you will know the exact reason silver is underperforming gold right now that nobody else is explaining correctly. You will know the single most important number in the silver market today that almost 0 mainstream financial media outlets are even mentioning. And you will know the precise framework, specific levels, specific calendar events, specific triggers, that will tell you what silver does next before the mainstream financial world even catches up. That is what we are delivering today. Now let us earn every second of your attention. Start here, right now, today. Gold is at $5,400. Silver is at 95. The gold-silver ratio is 55-1, and in the last 48 hours, this is what happened to the world. Supreme Leader Khamenei confirmed dead. US and Israeli warplanes running sorties over Tehran. Hezbollah opening a second military front from Lebanon this morning, with over 150,000 missiles pointed at Israel. Beirut being struck. Northern Israel under rocket fire. The Strait of Hormuz, the 21-mile-wide waterway carrying 20% of the planet's entire daily oil supply, closed for 3 consecutive days. Goldman Sachs pricing an $18 risk premium into every barrel of oil. Wood Mackenzie warning of $100 oil if the closure extends past 2 weeks. Brent crude at $82 and rising. The Dow Jones down 1.3%. The S&P 500 down 0.4%. Every risk asset on the planet selling off. And gold, pure monetary gold, surging 2% to $5,400. And silver, $95, 1.68% gain. Confused, frustrated, stuck. Now answer me this. In the middle of the biggest Middle East war in decades, with a 6-year supply deficit underneath it, with lease rates at 30 times normal, with American vaults being physically filled with silver right now, what on earth is holding silver back while gold goes vertical? The answer to that question is worth more to you right now than anything else you will read or watch today. And it starts with understanding something fundamental about what silver actually is. Here is the truth that changes everything. Gold is one thing, exactly one thing. Gold is fear. Gold is the asset humans reach for when civilization feels fragile. Gold has no industrial identity. Gold does not go into solar panels. Gold does not go into electric vehicles. Gold does not go into the semiconductors powering the AI revolution. Gold sits in central bank vaults and ETFs and jewelry boxes. Gold is bought when the world feels like it is ending and sold when confidence returns. That is the complete story of gold. Silver is infinitely more complicated. Silver is simultaneously a monetary safe haven metal and the most critical industrial metal in the modern technological economy. 50 to 60% of all silver demand every year comes from industrial applications: solar panels, electric vehicles, 5G infrastructure, medical devices, AI data centers, semiconductors. Silver is inside the technology that runs the modern world in a way that gold has never been and will never be. And that dual identity, that extraordinary combination of monetary safe haven and critical industrial input, is both silver's greatest long-term strength and its most treacherous short-term trap in a war environment. Because when war breaks out, investors buy silver's monetary identity. And simultaneously, the market starts selling silver's industrial identity, because war creates fears of economic slowdown, reduced manufacturing, and collapsing industrial demand. Both things happen at exactly the same time, pulling silver in exactly opposite directions with exactly equal force. And the result is what you are watching right now. $95, stuck, frustrated, but loaded with more compressed potential energy than any commodity on this planet. Now let us name the 3 specific forces holding silver back right now, because naming them precisely is how you track when they disappear. And when they disappear, every single one of you watching this video needs to understand, the move in silver will not look like 1.68%. It will look like January. It will look like the 47% spike to $121.67 that happened in a matter of days. Force number 1 holding silver back is the US dollar. When Khamenei died and the war news broke, global capital did what it always does in moments of maximum fear. It ran to the ultimate institutional safe haven, the US dollar and US Treasury bonds. Investors from Europe, Asia, and the Middle East sold local assets and bought dollars. Dollar index strengthened, and a stronger dollar makes dollar-priced commodities more expensive for international buyers, which directly suppresses silver demand and caps price. Gold has such overwhelming unconditional monetary demand that it absorbs this headwind and climbs anyway. Silver's industrial component makes it far more sensitive to dollar strength than gold. That is force number 1. Force number 2 is rising Treasury yields. The war is spiking oil. Spiking oil reignites inflation expectations. Rising inflation expectations mean bond investors demand higher yields to protect their purchasing power. Rising yields increase the opportunity cost of holding non-yielding assets like silver. When 10-year Treasury yields are rising, the relative attractiveness of holding silver decreases in real time. Again, gold's monetary demand is strong enough to partially overcome this. Silver's mixed identity makes it more vulnerable. That is force number 2. Force number 3 is the most psychologically powerful of the 3. It is the fear, not the certainty, just the fear, that the Federal Reserve reverses its rate-cutting plans because of war-driven energy inflation. Higher rates slow the economy. Slower economy means less manufacturing. Less manufacturing means less industrial silver demand, less solar production, less EV assembly, less semiconductor fabrication. The market is pricing this risk in right now, not because it will definitely happen, because it might. And in a market this sensitive to probability shifts, even a possibility of rate hikes creates real selling pressure on silver's industrial premium in real time. 3 forces: dollar strength, rising yields, Fed rate reversal fear. All 3 arrived simultaneously when the war started. All 3 are suppressing silver right now. And all 3, this is the critical part, are temporary. Now stop, because I need to tell you about a number. One number. The single most important number in the entire silver market right now, and I guarantee you that 90% of the people watching this video have never heard this number in any other financial channel or mainstream media outlet today. The number is 30. Silver lease rates, the cost of borrowing actual physical silver in the real-world market, have jumped 30 times their normal levels. Not 30%, 30 times. Let me make that completely concrete. If it normally costs a manufacturer or institution $1 to borrow an ounce of silver for 30 days, it now costs $30. That is the market screaming in the most direct and unambiguous language it has. Physical silver is acutely scarce right now. The gap between paper silver, the futures contracts and ETFs that exist on screens, and physical silver, the actual metal sitting in an actual vault, is widening at an extraordinary rate. American institutions are physically moving silver into American vaults right now. Above-ground accessible stocks are visibly depleting. The cumulative supply deficit since 2021 has exceeded 820 million ounces. That is an entire year of global mining output that the market has consumed and cannot replace. And a 30 times lease rate spike in the middle of a regional war is not noise. It is the loudest signal in the entire silver market. It is the signal that historically, every single time it has appeared at this magnitude, has preceded the most violent and most extraordinary silver price moves ever recorded. The Hunt Brothers corner in 1980, the 2011 run to $49, the 2020 pandemic squeeze, every time, without exception. A 30 times lease rate spike is silver's version of a 5-alarm fire, and right now, almost nobody is talking about it. Here is where the unpredictability becomes terrifying and exciting in equal measure. Because I would be failing you if I only showed you the bull case. The Oxford Economics War Assessment published today deserves your complete attention, even if you do not want to hear it. Oxford Economics, whose clients include the world's largest sovereign wealth funds, central banks, and institutional investors, projected a conflict duration of under 2 months. 2 months. Here is why that matters more than almost anything else I say in this video. The war premium driving silver from 92 to 96 this week is built on an assumption of sustained chaos. If the institutional smart money base case, per Oxford Economics, is a sub-2-month conflict, then that war premium has a timer on it. And when institutional money starts aggressively pricing that timer in, when the big funds start reducing their war premium positions, the speed of the premium deflation is not gradual, it is violent. Combined with dollar strength and rising yields, a rapid war premium deflation could pull silver to 88 or 85 with shocking speed. And the Coin Codex algorithm, which published a 7-day forecast predicting $79.92 by next Friday, would suddenly not look as crazy as it does today. Is 79 silver by Friday probable? No. The 30 times lease rate and the 6-year supply deficit make it genuinely difficult to sustain. But is it possible? In a market this volatile and this geopolitically driven? Absolutely yes. And the investors who did not prepare for that possibility will be the ones panic selling at exactly the wrong moment. Now here is the shockwave scenario, the one nobody is saying out loud. What happens if this war does not last 2 months? What happens if Hezbollah's second front draws in Iraqi and Yemeni proxy forces? What happens if Iranian retaliation escalates beyond missiles and drones into something that makes the Strait of Hormuz closure permanent for 3 months? In that scenario, everything we said about force number 3, the industrial demand fear, flips completely. Because sustained $100 oil does not dampen industrial activity gradually, it shocks it. Supply chains break. Marginal silver mines become uneconomical and close. The 67 million ounce projected 2026 supply deficit explodes to 120 million or beyond. The 30 times lease rate spike is not the peak, it is the starting point. And the physical silver squeeze that Bank of America was modeling when they published their $309 upper target becomes not a theoretical scenario, but a live, observable market dynamic. In that world, the forces suppressing silver today do not just disappear, they invert. And an inverted silver market, where every force that was pushing down suddenly pushes up, is the most explosive commodity market event that can occur. The spring does not just uncoil, it detonates. Here is your roadmap for the next 5 days, because this tension resolves this week. Today, the ISM manufacturing PMI tells us how the industrial economy is absorbing the war shock in real time. Wednesday, the ADP employment data and the Federal Reserve Beige Book drop. The Beige Book is critical. Any Fed language suggesting rate reversal fears are real sends dollar and yields higher and hits silver hard in the short term. Thursday brings initial jobless claims, and Friday, mark this in your calendar right now, the U.S. non-farm payrolls report. This is the detonator. If NFP disappoints, if the war uncertainty has already started chilling hiring, rate cut probability for May surges from 4.4% toward 30 or 40%. Dollar weakens. Yields pull back. All 3 forces suppressing silver simultaneously reduce their pressure. And silver, with 30 times lease rates underneath it, with an 820 million ounce cumulative deficit supporting it, with the gold-silver ratio at 55-1 pointing mathematically toward $150 silver at historical compression levels, does not drift gently higher. It moves with the same violent urgency it always moves with when the forces holding it back suddenly release. A strong NFP reinforces everything suppressing silver, dollar stronger, yields higher, rate cut timeline pushed further away. Silver tests 92 and potentially lower. Friday is the fulcrum. Everything pivots on that number. 3 scenarios, no comfort, no agenda, just data. Escalation scenario. Hezbollah intensifies. Hormuz stays closed past 2 weeks. Oil breaks 100. The Fed rate reversal fear becomes a rate reversal reality, and every force currently suppressing silver inverts simultaneously. $100 is not resistance, it is the launching pad. 120 happens within weeks. The gold-silver ratio compresses to 45 and below. Bank of America's upper range gets serious institutional modeling attention for the first time. The 30 times lease rate spike forces paper price to chase physical reality. This is the scenario where silver does not just catch gold, silver leaves gold behind. Containment scenario. Oxford Economics is right. Conflict stays surgical. Hormuz reopens within 2 weeks, and NFP Friday delivers a weak number that pushes rate cut probability to May. Dollar softens. Yields pull back. The 3 suppressing forces reduce their grip simultaneously. Silver breaks 97. Targets 100. The gold-silver ratio compression from 55 toward 50 produces mathematical silver upside of 12 to 15% from current levels without requiring any additional war escalation at all. This is the base case, and it is more bullish for silver than most people holding silver right now realize. De-escalation scenario. Ceasefire, Hormuz reopens, NFP beats, dollar surges, war premium deflates violently, silver tests 85 to 88. CoinCodex algorithm looks prescient for one uncomfortable week, and then the 6-year supply deficit floor reasserts itself. And the investors who understood everything in this video buy that dip with both hands. Here is the bottom line that every single person watching this needs to carry with them. Silver is not underperforming gold because silver is weak. Silver is underperforming gold because silver is the most complex, most powerful, and most misunderstood commodity setup in the entire financial market right now. 3 forces are holding it back. All 3 are temporary. 30 times lease rates are screaming physical scarcity underneath the surface tension. 820 million ounce cumulative deficit is the structural floor. NFP Friday is the detonator. And when this spring releases, in escalation, containment, or de-escalation, the move in silver will not be the confused 1.68% drift you watched today. It will be the kind of move that defines this market for years. The tension you feel watching silver sit at 95 while gold surges is not confusion. It is the last moment of calm before something extraordinary happens. And you just got the framework to understand it before it does. Drop your prediction right now. Does silver break gold's shadow this week and push through 100? Does NFP Friday flip the narrative and give silver its moment? Or does the Oxford 2-month timeline play out and give you one final entry before the real move begins? Every comment gets read personally. We are building the most honest precious metals analysis channel on YouTube from scratch, and this community is everything. If this video gave you clarity that nobody else gave you today, hit that like button right now. It costs you nothing. Subscribe and hit the bell, because the resolution of everything we discussed is coming this week faster than most people are ready for. I will see you in the next one.